Most discussions about wealth focus on the beginning, getting out of debt, building an emergency fund, reaching your first $10,000 or $100,000 invested. Very few talk about what happens after you've already done well. Yet in real life, a large percentage of people who eventually become financially independent report that the most dangerous stage was not the beginning, but the middle. One of the most common inflection points is around $250,000 invested. At this level, people rarely fail because they stop earning money or because markets stop delivering returns. They fail because their decision-making environment changes and they are not prepared for it. This video explains why $250,000 changes behavior in predictable ways, the traps that appear specifically at this level, and what the data suggests actually works instead. From a purely mathematical perspective, $250,000 is not special. There is no rule in finance that says portfolios behave differently at this number. But human behavior does. At $250,000 invested, three things happen simultaneously. Portfolio volatility becomes noticeable. Annual gains start to resemble real salaries. Losses become emotionally meaningful. For example, assuming a broadly diversified portfolio, a 1% daily move equals $2,500. A 10% correction equals $25,000. A strong year at 8% adds $20,000. These are not abstract numbers. They are large enough to trigger emotional responses. Behavioral finance research shows that loss aversion, the tendency to feel losses more strongly than gains, increases as absolute dollar amounts grow, even if percentage risk stays the same. This is why the same market movement feels very different at $25,000 invested versus $250,000 invested. Consider a common scenario. A couple in their late 30s has spent a decade saving consistently. They invest primarily in index funds through retirement accounts and a taxable brokerage account. Over time, they reach approximately $250,000 invested. During a strong market year, their portfolio increases by roughly $30,000. Nothing is sold. No cash is withdrawn. Yet psychologically, something shifts. They begin to think, our money is working hard now. We're finally ahead. We can afford to loosen up. They upgrade their car and increase their lifestyle spending by $500 per month. That $500 does not feel risky. Their portfolio swings by more than that in a single week. The issue is not the car. The issue is spending based on unrealized gains. When markets later experience a normal correction, portfolio values drop, but the higher spending remains. This pattern is well documented in financial planning research and is a major contributor to what planners call lifestyle lock-in. Fixed costs rising in response to temporary market performance. At lower portfolio values, investors tend to think in percentages. At higher values, they think in dollars. This is not just anecdotal. Studies in behavioral economics show that people mentally switch from relative to absolute framing as stakes rise. A 10% loss at $50,000 equals $5,000. $250,000 equals $25,000. At $250,000, that loss may represent a year of contributions, a large emergency fund, several years of discretionary savings. As a result, investors at this stage are more likely to panic during market downturns, reduce equity exposure at the wrong time, sell after losses, and re-enter later. Ironically, these behaviors reduce long-term returns far more than market volatility itself. Trap 1. The illusion of arrival. One of the most documented behavioral errors at this stage is the illusion of arrival. The investor is objectively not financially independent, yet subjectively feels close enough to justify changes in behavior. This leads to reduced savings rates, increased lifestyle spending, more tolerance for financial risk. The illusion is reinforced by social comparison. At $250,000 invested, an individual is far ahead of the median household, which strengthens the feeling of success. But wealth is not about relative position. It is about sustainability and resilience. Trap 2. Overconfidence and strategy switching. A second common error is overconfidence. Research consistently shows that investors who experience positive outcomes attribute success to skill rather than circumstance, even when returns were driven primarily by market conditions. At $250,000, many investors begin to reduce diversification, increase concentration, experiment with speculative strategies. Examples include stock picking after years of index investing, options trading on the side, crypto, or alternative investments without understanding risk profiles. The problem is not experimentation itself. The problem is scale. Mistakes made with $10,000 are educational. Mistakes made with $250,000 are structural. Trap 3. The comparison and catch-up effect. At $250,000, social comparison intensifies. Investors begin comparing themselves not to where they started, but to higher-earning peers, online success stories, early retirees. This creates what psychologists call relative deprivation, the feeling of being behind despite objective progress. The result is often increased risk tolerance, use of leverage, attempts to accelerate wealth. However, compounding does not reward speed. It rewards consistency and time. Many long-term failures occur not because investors took too little risk early, but because they took too much risk too late. Why $250,000 is a high-risk zone? The reason this stage is uniquely dangerous can be summarized simply. At $250,000, you have enough capital to damage yourself, but not enough to recover easily. A 30% drawdown equals $75,000, may represent 5 to 10 years of contributions, can delay financial independence by a decade. This is why financial planners often describe mid-accumulation as more dangerous than early accumulation. The evidence is remarkably consistent. Investors who successfully move from $250,000 to $1 million tend to maintain simple portfolios, avoid frequent changes, keep fixed costs stable, ignore short-term market noise. At 7 to 8% long-term returns, $250,000 grows by $18,000, $20,000 annually. The next $250,000 is reached much faster than the first. This is the point where compounding becomes visible, but only if behavior does not interfere. Consider a second example. An individual reaches $250,000 invested at age 40. Instead of changing strategy, they continue automated contributions, maintain a high savings rate, avoid lifestyle upgrades, ignore speculative opportunities. By age 50, without any extraordinary moves, the portfolio exceeds $600,000. By age 55, it approaches 7 figures. No leverage, no market timing, no brilliance, just discipline and time. Beyond returns, $250,000 provides psychological and practical flexibility. People at this level often experience reduced desperation at work, better negotiation outcomes, increased willingness to walk away from bad situations. These effects indirectly improve earning power and decision quality, further compounding long-term results. At this stage, your job is not optimization. It is risk management. Specifically, avoid irreversible mistakes, control lifestyle inflation, maintain diversification, protect long-term compounding. The biggest danger is believing that intelligence or activity will outperform patience. Reaching $250,000 invested is not a finish line. It is a transition point. At this level, the math of investing becomes less important than the discipline of behavior. The market will continue to do what it has always done, move up and down unpredictably. What determines the outcome from here is not intelligence, access to information, or sophisticated strategies, but the ability to avoid self-inflicted damage. The core rule at $250,000 is simple. Your job is not to get clever. Your job is not to screw it up. This is the stage where people who maintain boring, repeatable habits separate from those who stall. Investors who stay diversified, control lifestyle inflation, and resist the urge to chase returns dramatically increase their odds of reaching financial independence. Those who mistake momentum for mastery often give back years of progress through unnecessary risk, overconfidence, or spending against unrealized gains. Importantly, $250,000 does not make you rich. It does not eliminate risk. It does not guarantee freedom. What it does is amplify the impact of every decision you make from this point forward. Small mistakes become expensive. Emotional reactions become costly. Discipline becomes disproportionately valuable. The investors who succeed past this stage are rarely the most aggressive or the most impressive. They're the ones who remain consistent, patient, and focused on long-term outcomes rather than short-term validation. At $250,000 invested, your behavior matters more than ever. Protect it, and compounding does the rest.